So we're going to be talking about relative strength index and the average true range for today's technical analysis. If you missed out what I said about fundamental analysis and technical analysis, let me just repeat that for you. So an investor or a trader looks at two types of analysis. One is fundamental analysis and the other one is technical analysis. Technical analysis is something that we are going to be diving into today. But let me just lay a foundation for those of you who are very new to trading or very new to investing. Fundamental analysis, for example, let's say you're looking at Amazon as a stock. You want to purchase the shares of Amazon. What you do as a fundamental analysis is you do a research on what kind of revenue Amazon has been making for the last 2 to 3 quarters or last 2 to 3 years. You look at their revenue, their growth, their future prospects, and look at their next 2 to 3 years forward guidance to understand if it is worth buying Amazon today to make those returns in the future based on their past historical financial statements. Of course, apart from the financial statements, you can look at what kind of business modules they have and what are the new businesses that they're venturing into. Are those new business up to the latest technology, and is it worth is Amazon worth investing into those business? Will it be more profitable for the company? So these are the analysis that an individual can make before investing into Amazon shares. That comes under the fundamental analysis. Now let's take technical analysis. Technical analysis is basically an analysis that is done based on the price movement of the particular stock. Let's say for example, there's a stock that has been listed in the stock market for the last 10 to 15 years. So what a technical analyst does is looks at the historical behavior of that particular price movement. Just to give you an example, let's say every time the stock moves up, maybe 30 to 40%, we see the stock again drop back down to 10 to 15%. And every time the stock price has dropped down by 10 to 15%, you see the market go up back up again. Then again, you see a drop of 10 to 15%. Let's say you see a similar pattern that repeats itself over a period of time. This gives you an indication in terms of technical analysis, the behavioral pattern of an investor or a trader where they anticipate to buy back the stock. In this particular example, it is very obvious every time the stock has dropped by 10 to 15%, it is a good level to ideally think of buying and holding. Of course, now you cannot rule out fundamental analysis completely, but in the long run, whenever you're doing a long term trade or a long term investment, fundamental analysis is more weighted. Of course, technical analysis will support where to which would be an ideal price to buy into that particular stock. But when you're doing a very short term trade, let's say you're a trader who is looking at taking advantage of next 20 to 30 minutes or probably next 1 hour to 2 hours, you might be more focused on technical analysis rather than fundamental analysis. For an example of a short term trader is knowing the fundamentals of Apple stock, which can be a good investment for the next 4 to 5 years, is not going to help us make a decision on a short term trade when we're looking at a 30-minute time frame move. Because Apple on a 30-minute time frame move, you can expect Apple to move up and down roughly or about 1 to 2%. Now, 1 to 2% was not based on a fundamental move, it would have been more on an intraday level move. And this is where technical analysis comes into play and which is more useful for short term traders. However, both are important. It is just the right usage of what kind of strategy you have for yourself and using the analysis which is more suitable for your investment objective is what is going to help you identify good opportunities in the market. I hope everyone can hear me now. Moving forward, let's get into the first indicator for the day, which is relative strength index. Now, relative strength index basically is a momentum indicator used in technical analysis. It measures the magnitude of a recent price change. So the price change can be both upside or the downside. It is just going to help us identify the magnitude or the strength of an upside move or a strength of a downside move. So basically, RSI is also known as an oscillator. Oscillator is basically it moves between two different points, and that's the maximum move it can have. I will show you an example of RSI as I move forward. If you have not used a platform before, this is the very first time you'll be using a platform, please request for a demo account. This is how our platform looks. Once you open it, this is how the chart on our platform looks. Once you open the chart, I'm using S&P 500 right now. S&P 500 uh, is the top 500 companies of US. Of course, this is not the latest snapshot of S&P 500, but this chart is just used for demonstration purpose. In S&P 500 or any other instrument that you choose, you can go down to technicals. Then once you are in technicals, you have two different options over here: overlays and studies. In studies, you click on studies, it will take you where you can find RSI. One more simple way to do this is you can just type RSI in this magnifying glass, which is your search button. So RSI basically stands for relative strength index. Short form is RSI. Moving forward, once you click on RSI, this is how an RSI opens up. Let me just go back. This is a plain chart over here. If I move forward, this is how RSI is at current, how it looks currently. So I'm looking at a weekly time frame, meaning every candlesticks over here represents a week or a weekly move. Now looking at the RSI, like I told you, RSI is an oscillator, meaning RSI can oscillate only between these 2 points. Whereas market can come down, market can make new highs and continue going up, market can make new lows and continue going down. But then RSI always trades in a range. Now RSI basically again the range is defined 0 to 100, the percentile move. The midpoint is your 50%. The higher point we can always modify as per our requirement. In this case, the most standard way RSI is used 70% on the higher end, 30% on the lower end is where we can expect the oscillator to move between. Now, can the oscillator go beyond 30%? Can it go to 10% on the lower end? Yes, it can. And can the oscillator go beyond 70% and go all the way till 100%? Yes, it can. All right. It all depends on how much of momentum is there in the market. Now, a very small example on this particular chart that you can see, every time the oscillator has gone on the higher end, it is known as higher than 70%, which is kept as the current criteria. If it goes above 70%, it is known as an overbought region. In simple words, every time a market is in overbought region, we can always expect a reversal in the market and vice versa. Every time we see an oversold region, we can expect the markets to reverse back to the opposite direction of where it was heading towards. I hope so far it is clear in terms of how the RSI works. If you all have any questions in between, please feel free to write. I will try and answer as many as questions as possible as I keep moving forward. I hope I'm going slow as well so that you can understand how RSI works. Now we'll come back to RSI again. We'll come back to RSI. We'll look at RSI even on the live charts. Let's look at our next indicator, which is the average true range. In short, we call it ATR, the average true range. Basically, average true range is a technical indicator again that measures the volatility of an asset's price or a share's price or a commodity's price or a currency's price. So, in simple words, what ATR shows us is it shows us on an average. Let's say you're looking at a chart on a 30-minute time frame. On a 30-minute time frame, we want to understand how many dollars can a particular stock move. So if you select a 30-minute time frame, your ATR, which is the average true range, calculates as to how many dollars has it moved in the last couple of half an hours, let's say for the last 20 periods. Better example I would give is, let's say we are looking at a particular stock and we are trying to look at how many dollars can this particular stock move in a single day. All right. So what the ATR does is it calculates the previous 20 days, 30 days, or 50 days, depending on the criteria that we're going to make or give. to understand how many dollars did it move in the, let's say the criteria I've given is to understand on an average how many dollars it moved in the last 20 days. It will give me a result as of today. Based on last 20 days, we can expect a stock to move by a certain amount. I'll give you an example on this as well. Again, similarly, we go to technicals, we go to studies, and we find ATR, and you click on ATR to get ATR. Excuse me. You can also search ATR in your search button. Now, once you click on ATR, this is how it opens up at the bottom. Now, I'm looking at S&P 500 again. Now, I'm looking at a monthly time frame. Meaning, I'm trying to identify how many dollars can S&P 500 move in a single month. On an average, how many dollars can it move? Now we have data all the way from 1995 till now. Again, this is not the latest chart as of today. It's still a delayed chart only for presentation. I will show you the live version of S&P as well. Now, if you notice, S&P has the average movement. The average price movement is always on your right hand side. At this point of time, when we had taken this particular chart to identify how many dollars it can move, it shows S&P moves about $236 as of today in a single month. Now, how does ATR help us? Why do we need to understand how many dollars it moves? It is very crucial for us to understand how many dollars ATR moves, because depending on that, we can always strategize your entries and exit. For example, one disclaimer here I would also say is, when I say SPX can move $236 on an average in a specific month or in a month, that does not mean it gives you the direction of the market. The $236 can be even downside. The $236 can also be a move upward. The $236 could also be a move between the high and the low. So the average movement is $236. But how do you use this particular information to take advantage, or what is the benefit of this? Is when you enter into a particular trade on certain signals, you will always be able to understand how many dollars you should be anticipating for you to make profit. And of course, when it goes against you, how many dollars can you expect it to go against you? So, and having that knowledge will help you keep your take profits and stop losses accurately, and you don't end up keeping a take profit too close where you book a very small amount of profit. At the same time, you do not keep a stop loss too far away where your loss becomes a very huge loss. Again, all the explanation I will show it to you on live charts as well, so that it's more easier for you to understand. Moving forward now, coming back to divergence in RSI. Now, of course, RSI, like we understood, RSI goes up above 70%, it is overbought. RSI comes below 30%, it is oversold. Every time it goes above the overbought, the trend could reverse. Every time it comes down below the 30%, the trend could reverse again. But how about, we cannot always depend on one single indicator. There are always drawdowns about every indicator. Each of these indicators are based on past historical moment. So, meaning it could also be a lagging indicator. So, it is always best to combine two or three more indicators to get at least two to three confirmations before you take any investment decision, or if you're looking at trading, before taking any trading decisions as well. Now let's look at another indication that we can look at while we are looking at RSI. Okay, this is known as the divergence while you're looking at RSI. So divergence basically is a concept in technical analysis which describes the price is moving in the opposite direction of the technical indicator. Let me show you an example over here. What we saw here was the RSI, which is the technical indicator, and S&P 500, which is the index or the price movement of the index. It moves in tandem. If you see the price dropping, you see RSI dropping as well. If you see the price going back up, if you see the price going back up, you see the RSI moving in tandem with the price of the particular instrument that you are looking at. But when it comes to divergence, the name says it all. Basically, it goes in opposite direction. Meaning, if the price is going up, the RSI is actually coming down. Now, this is known as a divergence, where a lot of traders or a lot of investors try to take advantage of a divergence. A divergence is a simple, in simple terms, if there is something that has high correlation. Let's say we have backtested a particular instrument, or a particular thing which has particular two things which has very high correlation, meaning the correlation between the both is about 90 to 100%, meaning if product A goes up, product B as well goes up, because they both are highly correlated. Now here comes an opportunity when product A goes up and product B goes down. We have a divergence. Now people take advantage of the divergence because based on historical data, if you do a back test and see, the divergence happens once in a way, and most of the time it always converges back because it is highly correlated. Now I'll show you how the divergence and convergence work as well in the next slide. So there are two types of divergence that we'll be looking at. A bullish, which will be a bullish bias. When I say bullish bias, that means we can see a divergence which is indicating the market can start moving up. On the other hand, we can see a bearish bias which will indicate the market can start going down. Now, moving forward to an example of a regular. So there are two types of divergence in divergence of the RSI. Most popularly used is the regular divergence. The other one, you probably might not hear it more often, but the regular one is what most popular technical analysts keep looking out for. A regular divergence basically is used to identify a possible sign of trend reversal. And why is trend reversal important? Very simple reason, you would always buy a stock when it is cheaper. For example, there's a stock that is trading at $100, you would always want to buy it when it drops down by 10, 20, 30, 40%, because now if you buy it at a cheaper price and then let's say the stock dropped down to 70% and it jumps back up to 100. Now if you bought it at 70 and it jumped back up to 100, you make a good return of $30. Whereas if you end up buying it at 100 and then it drops to 70, you might end up losing. So if you're trading or if you're investing, you're always doing a reverse trade. You're always going to be going against the trend of the market. The reason, because you'll always want to buy when the prices are cheaper. And if the prices is coming down, the market sentiment is negative and you will be buying on the opposite side of the market. And this is where your technical indicators and the fundamental analysis come into play. Let's say, for example, Apple today being a very good, strong fundamental company, but on a short term, Apple has dropped 10 to 15%. Now, although there is negative sentiment for Apple for why it has dropped, I would still make a choice of whether buying Apple today, because I know the fundamentals of the company and I know its history. But at the same time, my technical analysis is also giving me a signal that Apple is being on RSI, it has come to overbought. So I will show you a couple of examples on the live chart. So hence, I would like to buy it. So it is a regular divergence always helps you identify trend reversal. You'll always wait for the market to drop and you expect the market to go back up, and that is where your regular divergence helps you. Let's look at the bullish divergence. So bullish divergence are people who are looking at buying a particular instrument, buying a stock, buying a commodity, buying indices, buying a particular stock. It does not matter what instrument you're looking at. Technical analysis apply the same for all the instruments on the charts. Now let's look at this particular instrument. We are looking at Euro USD. We see Euro USD is making lower lows. So basically, instead of the candlestick, I'm just using a line chart. There are different types of charts that you can use as well. Earlier, what we saw in these examples, we were looking at a candle stick, but I can just change this to even line chart and look the same. Now coming back to a regular bullish divergence. Now I see the market is making new lows. Okay, the price is making lower lows, meaning every time it is coming down, it is going back up, but it's coming down and making a newer low before it goes back on top. So while this is making newer lows, it indicates that the price is getting weaker and weaker, right? But RSI is actually doing the reverse of it. RSI, instead of going into oversold territory, RSI is in fact coming up while this is going down, while the price of Euro USD is going down. Now, this is where you found a divergence where the price of the particular instrument is dropping, whereas the RSI, the technical indicator, is going up. Now, this is where you identify a bullish divergence and you expect the prices to jump back up because the RSI, if you remember, is relative strength index. The strength on the downside is pretty much over and it is picking up strength towards the upside. So hence you can take a buy position based on this divergence, and of course we will come to risk management even on this. Everything that has a good anything that has a good signal, giving any indicator that gives you a good signal, that does not mean cannot have risk associated with it. Yes, this RSI could have failed and gone back to oversold, and the price could continue dropping as well. So this is where we need to learn how to manage the risk, which I will be showing you on the live charts. That is the bullish divergence. Of course, the bearish divergence is the opposite. Now, if you are a short seller in the market, if you're aware of short selling, you sell at a high price. Basically, you short sell, and if the price drops down, you make money on that, right? For those of you who do not understand short selling, do not worry about it. Basically, let's just look at identifying where the price of a particular instrument can drop from. In this case, now you see higher highs. The price is making higher high, but the oscillator, the RSI, is making a lower high. Okay, earlier was it was making lower lows and higher lows. Right now, it is making higher highs, meaning the price is shooting up very strongly, but my relative strength index, the index which is showing the strength in the market, is not very strong. In fact, it is weakening down. Again, we see a divergence over here, meaning we can expect the prices to drop, and the prices have dropped in this particular example. Now that is your bullish and bearish divergence, and these are two indicators that you can combine to get a signal. However, again, these two signals are not the only technical indicators that is available on the platform. You have many other technical indicators that is available. I would recommend you should look at 2 to 3 indicators, and you need to backtest and identify which indicator works well on what time frame. And I will also explain a bit of how to analyze which indicator works best for you and for which instrument and for which time frame. But this is just a foundational course to understand how RSI works, and using RSI how we can find divergence in the market and find trading opportunities. Now, the regular divergence is best suited to use when you're trying to pick a bottom to buy or you're trying to pick a top to sell. Hidden divergence. So basically, hidden divergence, while we were looking at a regular divergence, we were looking at divergence where it can help us identify reversal in trend. But a hidden divergence tells you a possible sign of trend continuation. Over here, you're not looking at a price to drop and then to buy it. Over here, this particular divergence is actually showing you if the market is going up, you want to use the trend to continue the trend, and basically that is what hidden divergence is going to help us identify. Now let's look at hidden divergence. In this case, higher lows, basically the price is going up, when it drops it is not going back below this, it is making a higher low. So every time the price goes up it makes a higher low, meaning buyers are buying back into the particular, we are looking over here is Tesla Motors. Every time the buyers are trying to buy back into the market. Whereas if you look at the RSI has gone to oversold. Remember the example where I told you when RSI goes into the oversold region, we can expect the trend to reverse, right? Now, the trend reversal is happening in RSI, but whereas the price movement, the trend is still continuing on the upside. So when you find a reverse divergence, which is the hidden divergence, you can identify overbought region, whereas the the higher lows, to take advantage of the trend continuation. and vice versa for the bearish. You'll see lower highs. Markets are going up, but it's making lower highs. But if you see, the RSI is making higher highs coming into overbought, expecting the market to reverse back, expecting the market to continue the trend. Over the trend has come down, made a lower high, so that means it is still on a downtrend, and the trend continues. So you take advantage of the downtrend. This is what you do on a hidden bearish divergence. This will need couple of practice to identify and get familiar with the terminology. I hope so far the idea is clear in terms of how to enter and exit. If the divergence is creating any confusion, do not worry about it. Once you go through the hidden divergence or the regular divergence couple more times, you will be able to identify this divergence by just looking at a chart. But for now, the foundation is how do we use RSI to identify entry opportunities? How do you combine probably another technical or other analysis to get a better signal to identify opportunities in the market? Now, key takeaways very simple again: regular divergence signal possible trend reversal, whereas hidden divergence signal possible trend continuation. Well, now this is the theory part of it, and we can go into the live charts, and I will share my live screen with you and show you a couple of trades purely only on RSI. How does it look when RSI is at overbought, oversold? If there is any specific instrument that you want me to look at, please write it in the chat so that I can open those charts live as well, and you can do an analysis with me. Before we move into the live chart, I just wanted to also share an app that we have. It's known as Quantifier. Basically, it can help you get automated trading strategies. So instead of you doing all your analysis, you can get the system to do it for you. So that is what Quantify helps you do. Basically, it has all the data. If you have to do any sort of analysis, you need to have a lot of data. Let's say, for example, you're doing an analysis on Apple for the last 5 years, and you want data of the Apple prices for every 30 minutes move for the last 5 years. Now, this is something where you'll have to get the data from, upload on your Excel, and get the analysis running. But over here, you can the app does it for you. It pulls down the data and does the analysis for yourself. So basically, this is Think Quantifier. I'll just show you a small demo of how it looks when you open on your mobile. So as I was mentioning, let's talk about the app. So the app provides the ability to backtest and analyze multiple strategy parameters on intraday as well as long-term duration data. The app supports top traded US market instruments including indices, equities, cryptos, commodities, and forex. With the app, the client can adjust the risk reward to his preference and see how the performance parameters change. The app will be initially free for new Century clients and will serve as value add over consultancy and sales services. Now, as you all can see on the app, we have the first parameter where you look at the markets, you have product at the bottom, you have quantify, research, and analyzers. Let's just go through each of these tabs. So in your market, as you can see, we have selected US equities. US equities has all the stocks that you can see right now. You can also look at the heat map as to what is the percentage change that has happened today in the gainer side, and of course on the losing side, which are the stocks that has gone down. So you have a quick view on a heat map as to which stock has dropped by how much percentage. At the same time, you have a quick view of what are the stocks that has gained today and what percentage movement has happened for the day. You can do the same for indices, currencies, cryptocurrencies, and commodities. Now, going to our next tab at the bottom, product. Now, in your product, you have your equities, indices, currencies, and cryptos. Again, now let's say you want to look at 3M, you will get the entire data about 3M, including the chart. You will know the 52-week high, 52-week low, the year-to-date return percentage. So all the data that you would require about a particular stock, you will be able to see on this particular tab. Now, going to the research. Now, research is where you can get a detailed analysis or a research report of anything that can be trending at this point of time or any good opportunity that comes up. For example, you can probably look at Brent and WTI spread rate when the opportunity arises. You will see all those research been put up over here. According to your investment strategies, you can pick the right research strategy for yourself, and then go ahead, by discussing it with your consultants. So you have all your research reports that you can access at this particular tab. Now, on the last tab over here, you have analyzers. And analyzers is basically a premium services. This particular page will give you in-depth research strategies, analysis, pattern recognitions, and a lot of other features which we will soon show you as well in terms of what you can get in your premium services. You can always get in touch with your sales RM, or you can get in touch with your consultants once your account is open to understand what all you might get under the premium service. Now, coming back to the main thing that we were discussing about is how do you backtest a strategy. So you can create a backtest strategy yourself based on the parameters that you want to put in, based on your risk reward profile that you have for yourself. For now, for today, I'm just going to show you a strategy that we have already set in place, and let's just go through how this particular backtest has worked out and what kind of entries and exit were made and what kind of returns and drawdowns could we see on this particular strategy. So basically, this strategy is SPX short, S&P 500 short. So the idea is sell 100 units of when the relative strength index, the RSI, which we had just discussed about previously, when the number is above 70%, on a 30-minute candle. So you're looking at a 30-minute time frame to get a signal to enter on shorting the market when RSI goes above 70%. So this particular strategy has been tested, back tested all the way from the 1st of Feb of this year till date. So let's look at how the performance of this particular trade has been for now. So once you click on the backtest, now it will go and show your performance for this particular trade. Now let's go into the strategy. Now you see how the performance, if you had to follow the particular strategy, basically short selling whenever RSI is at 70% and above, which is the overbought region, and on a 30-minute time frame. Now we have got about 54 trades for the last 5 months. The hit ratio has been quite decent, 55% on this, 30 positive trades, 24 negative trades. You have your cumulative PNL, which is $40,000. You have your max drawdown. You have your drawdown, which is about 31,000. Max losing streak is about 8,500. Max winning streak is about 9,900. Your cumulative return is about 8.46%. Now, looking at these data and these parameters, and based on your risk appetite and based on your preference in terms of the parameter settings, you could always tweak and make your own strategies. This is just a sample strategy that I want to show on Quantify and how that may help you identify signals to enter and exit based on your risk appetite and your objective for your account. The signals for these trades and how the app works more in depth. Training would be given to you by our sales and your consultant once you have opened an account with us. So please keep in touch with your RM, and any future updates on the app will be notified to you as well. Right. So basically, that is how the app helps you find trading signals. Again, just to summarize this small demonstration of how the app works. Let's say instead of you doing a manual analysis of buy and sell on RSI overbought and oversold, the system does it for you. And whenever you get a signal from the system, you can go ahead and take the trade. However, you have to set your parameters even with your stop losses and take profit. So, so if the trade is against you, you need to set in terms of what percentage of loss and what percentage of profit you're looking to take on every single entries that you'll be making based on the batch tested strategy. This is just a demonstration. Now let's get into the live chart. before I go into the live chart, if you found this webinar informative, and if you have any review that you want to give, if you have any feedback that you would want to share with me, you can always share on this current chat as well. And if you can review us on Google, that would be truly appreciated. By the end of the webinar, I would also request, please share your feedback on this particular webinar. If you have any feedbacks, if you have any questions, if you have any other future requests, you can always write in the chat. Now let's dive into the live charts. All right, now I've just shared my live screen over here. I hope most of you all are able to see it. If you're entering into this particular platform for the very first time, this is how it opens up. When it opens, you have your product library, you have your chart on the side, you have your positions. If you want to buy, sell, you'll see all your positions at the bottom over here. In terms of watch list, you can make your own watch list. There are a lot of features on this particular platform which can help you. There's also a button over here where you can helps you identify me now. Please let me know once you can hear me. I'll just share my screen again. Hi, I'm sorry about that. I think there was some technical network issue again. I hope you all can hear me now. If at any given point in time, if you cannot hear me, please immediately type it out on the chat message so that I know that you're not able to hear me. Let me just quickly jump back into the chart. So you have your search button. and click on SPX. I'm entering into SPX. If you all have any specific instrument that you want me to look at, we can dive into that as well. So let's look at SPX because SPX is the top 500 company index. So you can see the performance of SPX for the last couple of years. Now this is your time frame. I'm going to be choosing a monthly time frame. This is how SPX has performed from all the way from 1995, and this is where it is as of today. The market has recovered quite a bit in the last 2 3 days. Now, coming to our RSI technicals, you click on RSI. Okay. Now, these are your overbought region. I'll just make this bigger. Overbought, oversold. In this case, it's not come to oversold in a very long time. When you're looking at a monthly time frame, of course, it's a very very long time frame. Now, if I dive into a smaller time frame, now let's come down to a daily time frame. Now you see on a daily time frame, market has gone to overbought, oversold positions. It was recently again at oversold position at this price. Now it is almost coming to overbought region again. So now this is how the oscillator works. But if you look at the markets from this particular period till here, if you see the market has just been going up, in fact making new highs, but you will still you will see the oscillator moving up and down because it oscillates between 2 points only. Now, has these oscillators shown a reversal in market? Let's look at a reversal here. What happened at this point of time? Yes, there was a reversal there. Let's look at the downside where it was oversold. This was oversold, so it bounced back up. And basically, these are very, very basic. You cannot completely depend on just overbought and oversold, like I told you earlier. You need to combine these with few other indicators to get a solid indication or the opportunities. Now, let's look at a very small time frame. Now, we understand how RSI works. We had also touched on one more indicator in the beginning of today's session, which is the ATR, average true range. Now let's look at ATR. ATR, like I mentioned to you, I'm looking at a daily time frame. Let me just make the screen a little bigger so it's more easier to see. I'm looking at ATR. Again, just to recap what ATR is. ATR is average true range. Let me just remove all the grid lines. Average true range, in short, ATR tells me how many dollars can SPX move on a daily time frame. So basically, if you see, I said if I can measure it for the last 14 days, I can change the parameters for last 15 days, 20 days, 100 days. It completely again depends on how much optimization you want to do for a specific strategy or for a specific objective that you have for your account. What I would recommend is stick with 14 for the beginning because that is the standard that most of the technical indicators are placed on. You can modify it as you backtest more into the past and see which one gives you the best results. Now, in this case, I'm looking at 14 days. In the last 14 days, the average is about $80 move in a single day. Now, let's look at how much SPX has actually moved for the day. It has moved about $32. Now, if I take the entire move for today, this is the low it had made. This is where it is right now. Okay. So the $33 it is showing is from the time it opened. It opened at this price and currently it is trading at 4,050. So basically it opened at 4,018 and now it is at 4,050. So that's roughly about 34 to 35 points higher. But the entire day's move right now, if you see, it has moved about $64 already, including the lowest point it made today and the highest high it has made, and looks like it is continuing to make a newer high for the day. Now, why does this information help me, or how does this information help me? On a daily chart, I understand SPX moves on an average $80, and it has already moved roughly about $65, meaning I can expect it to go up another $15, so it completes the $80 move. Now, it does not necessarily mean just because RSI has indicated $80, it will move exactly $80. It can increase, it can decrease, maybe it might not make a $80 move for the day, it might start reversing from here. But me having the knowledge that it can move $80 and it has already moved up by $64 at this point of time, let me go into a smaller time frame and see if RSI is giving me any signal. Let's go to technicals, go to my RSI. Now I'm combining my RSI, okay, on a daily time frame. I'm combining my RSI with my ATR. ATR is $80. I understand that the market is moved already $70, $65. Maximum as per the ATR, it can go up another $10, $15. And my RSI has come to overbought. What did we learn? Every time RSI goes to oversold, if you see over here, it was oversold, right? And what happened to the market from here? Market from the overbought oversold region, which is somewhere here, the prices eventually started moving back towards the upside. Of course, it is still not gone to the overbought. Right now, it is reaching the overbought region. Now, looking at ATR, I understand it moves $80. Looking at my RSI, which is almost at overbought, it is still not crossed yet. But let's assume it has crossed in this particular example. If I look at a 4-hour chart, on a 4-hour chart, you see it has already crossed. So I can expect a reversal in the market at this given point in time. But if I'm expecting a reversal, I can take a short position. So for people who do not understand short position, this is how a short position would look. Instead of taking a buy in the market, I'm going to click on the sell. To understand short position, if you're very new to this, I would recommend do a couple of videos on YouTube just to understand how it works, what is the system behind how a short position works. But for this particular webinar, I'll keep it very simple. A short position is something where instead of buying, you can directly sell. Let's say I'm going to take a sell of 10 units, and if the price of SPX drops, meaning right now it is at 4,053, let's say it drops by $50, it comes to 4,000, I will make money. But if the price goes against me, if it goes up, I lose money. Exactly opposite of buying into the market. Now on a short position, why am I taking a short position? One is on my daily time frame, or the ATR has shown me that it can move $80. Pretty much almost $80 move has happened for the day. But at the same time, RSI on a shorter time frame and including one day is almost at overbought. Now I would take a short position. Let's say I have a $10,000 account. In this case, I'm taking a $40,000 exposure. It is highly recommended not to take leverage. I'm just taking $40,000 here just to show you as a demonstration. But if you have not used leverage, if you're not aware, I would recommend please trade or invest without using leverage until and unless you understand how leverage works. And if at all you do understand how leverage works, make sure you always have your risk management, your stop loss, or any other counter risk management strategies that you have for your particular portfolio or trade ready when you're taking leverage. In this case, I'm going to be taking a short, meaning I'm expecting the prices to drop back down. Now I'm going to put my stop loss and take profit. Now, how much stop loss can I put? I know on an average ATR is showing me SPX moves $80. It has already moved $65. Now I can always keep another $80 move upside. To make it simple, I'll just do one unit, right? So I can keep a stop loss of $80 on the higher end. Okay. Meaning on an average, SPX moves $80. I've kept a stop loss $80 higher, meaning 160 points. $160 is what SPX needs to move for it to actually trigger my stop loss. That is, if it goes against me. Now, of course, take profit. I will keep 80 as well because from here we can expect a reversal. If the reversal comes because of the overbought, we can expect the prices to come minimum to 80. Of course, if you want to increase your risk reward, you can always double your take profit, that is about 160. So if the prices drop all the way back to these levels, you make $160 profit. If it goes against you, it stops out with a $80 loss. Now, why is the stop loss very important? One is because if it continues going up, now let's go into a weekly. I took a trade on a daily time frame, so I'm looking at a short-term time frame. But if I look at a weekly, let's look at how many dollars can SPX move. In a week, it can move. At this point of time, it is showing a move of almost $199. So basically, a $200 move. Let's measure how much it has moved this particular week. I'm just going to remove the take profit and stop loss for now. On a weekly time frame, it can move about $200, and right now it has moved already $150, and I have kept a stop loss $80 higher than 150. So I have still given enough room in case SPX wants to go up a little more before it starts reversing on a daily time frame. Now this is a very small example of how you can use ATR with your RSI, but the most simplest ideas are the best ideas in terms of your risk management. You do not need to overthink of keeping your stop loss too far away, but at the same time you do not have to overthink of keeping your stop loss too close where your stop loss could trigger and you end up making a loss, and then the market moves in your direction. So this is where ATR is very crucial. As simple as it looks, it will help you a lot when it comes to your stop loss and take profit. And ATR is used for pretty much even a shorter time frame, even a longer time frame, even if someone is who's trading on a 5 minute chart. Someone who likes to trade a very short time frame, want to take advantage of the momentum which is currently there for the next half an hour, can also trade on a 5 minute chart. Now, in this case, a 5 minute chart shows me that SPX on an average currently is moving about 7 points. I'll open Nasdaq, which gives us better moment. Okay, let's open ATR for Nasdaq. Now I open Nasdaq because Nasdaq moves more than SPX. Nasdaq moves about $300 a day on an average as per the ATR. Let's look at 5 minutes. On a 5 minute time frame, Nasdaq moves easily $30. Now you do the same analysis. Let's open RSI. What is my RSI showing? It is showing oversold, sorry, overbought. So I can expect the price of Nasdaq to start dropping. Let's say I do sell on Nasdaq. Again, we are doing a short position, take profit. Now take profit and stop loss, very simple, 30-30. You're gonna keep a stop loss of $30, keep a take profit of 30, or you can keep about $60 as well. You can look at a little bigger time frame, a 30-minute time frame, which shows a $55 move on 30 minutes. So let's do 110. RSI is also pretty much at oversold. I take a sell. So now you have taken a short position, you kept your stop loss take profit based on ATR, you have taken a sell position based on your RSI signal. Of course, we are not jumping into the divergence and convergence yet, but this is just an example for us to understand how you can use your RSI and how you can use your ATR to take these simple trades. Now, the most successful traders are the ones who really do well in trading, are the ones who follow the discipline of the risk management and, very importantly, the leverage. Let's look at the position which is open. So, in this case, we have taken a short position. I'll keep the chart open as well so you can see it live. It's a very short term time frame, so I think the take profit or stop loss should happen within next 5-10 minutes. If it doesn't, I hope you all understood why we have kept a stop loss here, why we've taken a sell, and why we've kept a take profit here. If you all have any questions, I will be able to answer as well. I think most of you all are understanding it well, which is a good thing. So this is my short position that you can see. It's making a loss right now of $3. Yep. So it's making a loss. You can see the same trade on the chart live here. I'll make this 5 minutes. Yeah. So now it's crucial that I keep my stop loss here, because can markets continue going up? Yes, it can, and that is where you manage your risk. And like I was mentioning, the most successful traders are the ones who follow discipline, leverage under control, and consistency in terms of having the strategies in place, backtesting, and trading on those specific strategies. If you already have an account with us, please get in touch with your consultant to get more in-depth knowledge on the technical analysis. Probably he can share more videos and ideas with you. If you're new, you can get in touch with your relationship managers and get more details on the analysis and more future webinars that we may host. For today, we have come to the end of the session. I hope the session was informative. I hope this was informative for you. I hope you got to learn something new today. Please do leave in your comments in the comment box. If you have any suggestions, if you have any requests for me, please do that on the chat box. For today, I think we'll wind up the session with the ATR and the RSI. Please also do note any suggestion that we have given right now on the live platform is still demonstration purpose only. Please discuss it with your consultant because they will know your objective. You can be clear about your objective of what you want for your account, and then take decisions on your investments. Thank you again for patiently waiting for the webinar, and also my apologies for the technical glitches in between. Have a good day and hope to see you all again in the next webinar.